Hi, welcome to Let's Talk Forex. In this episode, we speak to Chris Weston, the head of research at one of our top brokers, Pepperstone. Chris provides excellent advice for beginner traders on how to create rules for trading. He covers trading strategies and the importance of risk management. He also talks about trading the dollar and cryptos. He is an excellent communicator, and we are sure that you will thoroughly enjoy this episode. As a heads up, I drop out of the conversation somewhere in the middle due to connection issues.
Hi, and welcome to this week's podcast. How are you, Alison?
Yeah, I'm very good. Thanks, Chris. Electricity seems to be holding up for this week, so feeling quite chuffed about that.
Oh, that's nice.
Yeah.
That's great news.
How are you doing?
Yeah, no, I'm okay, thanks. Just back from a flying visit to London, which was a lot of fun. Always exhausting, very expensive, but good fun. Let's move on quickly to. We've got a very exciting episode for people this week.
Yeah. I mean, as we mentioned last week, we have a very special guest joining us, Chris Weston from Pepperstone. So welcome, Chris.
My pleasure. Thanks for having me on, team.
Yeah, no, it's good to have you here, Chris. Chris is the head of research at Pepperstone, and you've been there for quite a while, right, Chris?
I've been at Pepperstone for coming up to 5 years now. Prior to that, I was at IG, and then before I moved to Australia, I was stationed in London and spent a number of years working both in sell side and buy side institutions, Merrill Lynch, Morgan Stanley, and in sort of more trading roles than research, where I'm sort of more in the research side of things now. But yeah, very much in the trading side of things on the sell side, and at Merrill Lynch on the buy side, working in the fixed income division there. So a bit of a mixture between everything really. But yeah, been at Pepperstone for nearly 5 years now.
People who may not know, Pepperstone is one of our favourite brokers, based in Australia. How long has Pepperstone been? When was Pepperstone founded, Chris?
We were founded in 2010, so yeah, we've been around for a while. Our DNA sort of spawned from the FX markets and the explosion in currency trading in 2010 and onwards. But yeah, now we've sort of branched out now. We've got 7 different licenses around the world. Yeah, we've got offices in London, Dubai, Frankfurt, and certainly, our footprint seems to be growing around the world as the interest in trading leverage products has been increasing as well. So, but yeah, so the headquarters at the moment in Australia. So yeah, it's a growing business, and yeah, good to see. Yeah, obviously, great interest in people looking to sort of trade the markets and trade their own individual strategies.
With our podcast, Chris, we mainly focus on getting beginners getting started on their trading careers. When you're just coming into this, coming into trading, where do you see that they should start?
Yeah, my advice would always be to master a trading strategy. And myself, I've got multiple different trading strategies. So I run a momentum strategies. On sort of longer time frames, position trading. I run some trend following systems, and also mean reversion strategies. Now, some of those strategies will work in different markets. But the way that I started off was very much looking at momentum strategies, so buying strong and selling stronger, on the belief that a body in motion stays in motion. So I would pick a strategy and become a master of that strategy. So for me, momentum makes a lot of sense, especially when you're trading very short termism. And you're trading with leverage, following the flow of capital is a really good place to start. And look at what indicators work for that strategy. Look at the market environment that's working. Is it a trending day? Is it a mean reverting day? If so, then move on to another market that's showing real momentum. Maybe the rate of change is going up and the price action is looking bullish. It's breaking out. But I would start with a strategy. What market environments does it work? What time frames do you like to work off? And those time frames are going to be very, very beholden to your own lifestyle and circumstances. So, when I'm talking to a client who's coming into the market, I can't just say, here's a strategy, go and take it away. They need to to manipulate that to fit what they're currently doing. If they're not a full-time trader, they might be a plumber, they might be a farmer, they
Right.
might be, I don't know, whatever they're going to be, but that they might be a full-time parent. Their ability to be in front of the screens will dictate the sort of time frames they're doing. So I would master a strategy, know what indicators best fit that, and know how to use those indicators correctly within the strategy, and also what time frames suit them, what sessions they want to trade as well. I think this is probably the best way to start.
Yeah, that's very good advice. And then on that note, you were mentioning that if a certain instrument doesn't have momentum for that day, which instruments would you recommend for beginners? And what economic events should they look out for that influence those instruments or those markets?
Well, I mean, it's a very difficult question to answer because we could be looking at systematic strategies. So creating a rule-based strategy. It doesn't necessarily have to be automated or algorithmic in nature, but just having a set of rules which you adhere to. Like the price action has to be above the 5-day exponential moving average. You has to be breaking out to a new 40-day higher. These kind of things that you have a checklist on, I think, are really, really important. So it's difficult to sort of really pinpoint how that's going to go down. But I do think that having a rule-based strategy is a really good place to start. But it can take some time to get into that point and get harness that one to its full extent.
Yeah, so it sounds to me what you're saying here is that education is really key before anybody jumps in. Building a trading strategy and learning how to use these indicators. And I know you offer like demo accounts and all this kind of stuff. Is that what you recommend, that someone sits with a demo account for a while and reads as much as they can and absorbs as much as they can?
I think when you're starting out, fundamentals can be very, very troublesome for a lot of people. Whatever they're looking at in the fundamental situation and saying, "Oh, the Australian dollar is going to rally against the euro as a result of this." The problem with a
Mhm.
lot of sort of fundamental issues that people take is unless they're properly schooled in the art of understanding thematics, they're probably either looking at the wrong thing or that news has passed and it's in the price, right? Because we live in the future as traders, right? We don't live in the here and now. We're pricing stuff in real time, and the problem with a lot of sort of fundamental analysis for beginners is they're either looking at the wrong thing, or the market's already fully discounted it, which is why I would always suggest looking at price action. Price action is the aggregation of all human behaviors, and non-human behaviors as well. And price is ultimately what we're trading, especially in the currency market. You go into the currency market, $8 trillion a day of global flows that are taking place. What you're seeing on that chart right there is the aggregation of all of those flows, be it through exports, be it through real money accounts, from leveraged accounts. All these different people are doing different things, and that's what we're trading. So you're trying to sit there and say, oh, this central bank's going to raise rates more aggressive in this one, so I'm going to buy that currency. Well, the market's probably already discounted it, and the price action
Mhm.
is reflective of that. So I would say when you're building a strategy, you know, it's really important to understand what the key central thematic is that's moving the market. Right now, if we take that, it's this obsession with interest rates. Could the Fed raise 50 basis points on the 22nd of March? Could we see the terminal price or the peak rate expectations going above 6%? And what does that mean for the dollar? What does it mean for the ECB if the ECB, the market prices in a peak rate expectation later this year, well north of 4%? What does that mean for the
Mhm.
euro against other currencies? The price is actually encapsulating a lot of that situation, and to understand what's going on in the interest rate markets, what's going in swaps, options, all these factors is very, very difficult for the average retail trader to do. So but it's good to understand what the central thematic is, and
Mhm.
therefore when we understand the central thematic, we can go into the heart of what trading is all about. It's not necessarily just about strategy, it's about risk management, it's about position sizing relative to the volatility in the market. And if you understand the thematic in the market, you can have a greater sense of what the market's going to be sensitive to when we see these event risks coming out. I'll give you an example. The market right now, as I keep saying, is very sensitive to interest rate expectations. So
Yeah.
what is the Fed looking for to raise rates more aggressively? Well, for the two major ones are the non-farm payrolls and the labor market, and also core CPI. And
Yeah.
therefore you put greater weight around those situations. And so when these data points come up, you need to make your decision. If your strategy is working, it's going well, you need to make a decision into that. How do I manage the risk around my position, knowing that there's this huge landmine in front of me? So
Mhm.
fundamental analysis is not necessarily just about entering the market. For me, it's understanding what's really important to the central banks, what's really important to the market, and then knowing when these event risks are coming up so that we can manage our position accordingly around that situation. Our job is, if we're running a long euro position into the ECB, for example, is the market expecting this to be a volatility event? Where is
Mhm.
the balance of risk around that situation? Is it higher or lower? And therefore we can make a decision whether we want to keep that exposure going into that meeting, look to trim back, or keep it going on. So, yeah, for fundamental analysis for me can be really important just to feel what the market's finding really important and use that to harness our risk management. Because ultimately, for traders, when you're getting into this game, building a system is fantastic, but ultimately we are managers of risk. We are managers of risk, and
Yep.
we try and achieve correct position sizing. That's what we do. So that's where I start with the fundamentals. What's important to the market? That's important to me. Get your calendar up and know when those event risks are going to be.
And on that note, how would you develop a risk management strategy? What would how would you go about it as a beginner?
Yeah, I mean, it's a great question, right? So, I mean, there's so many different ways I can answer this, but the first thing I would say, if you're trading with leverage, which I know a lot of your viewers or listeners would be doing so. So I would look at the options market. We don't offer options at Pepperstone, but I would look at the options market and understand using implied volatility as to what the market's expecting by way of movement. And if you can get that, then you can understand if they're thinking that it's going to be an event risk or not. What most people would do, though, who don't have these options pricing is look at realized volatility. And what we can use there really effectively is things like average true range or average daily range if you're using the different trading systems that we offer. So one of the things that we look at is the higher the movement in the market, and that market might be higher, it might be lower, but how it pulls away from a mean effectively. That to me will dictate two things. That would dictate my leverage and how levered I want my account to be, and secondly my position size. Because as traders, that's what we're trying to do. We're trying to achieve the correct position size relative to the volatility in the market and relative to the size of our account. I'm just not going to trade with a 500 to 1 account when euro dollar's moving 100 pips a day. But if euro dollar's moving 30 pips a day and trading very low range, then yeah, I can probably take my leverage up. Otherwise, I'm going to be trading at 100 to 1. The second thing then is your stop loss represents the risk that you're taking on a position. That to me is everything. So if I know the distance between my entry point and my stop loss, that to me is how much risk I'm taking in each and every position. So the distance between my stop loss and my position sizing is how much I'm prepared to lose, and I'm harnessing my risk. When I'm trading a momentum strategy, my win rates are very low. Traditionally in trend following systems and momentum strategies, you're probably running around 40% strike rates, which to a lot of people sounds very, very low indeed.
That is,
But
yeah.
but what you're doing is you don't need to be right every time. What you need to know is that when you make a trade that works, you need to extract as much juice out of that trade as you can possibly do. You need to cut your losses very quickly or let your stop loss, stay in place. But
Hmm.
what you need to do is all about the risk reward. I don't even consider the strike rate. I don't even consider the win loss ratio. Doesn't mean anything to me in those strategies. It's all about the reward that I'm getting for my risk, and I'm using a mechanical position. I've got moving averages that I use to keep me in the position as a stop loss. And now whilst a lot of your viewers will sit there and say, "Oh, moving averages are lagging indicators," the great thing about
Hmm.
having a moving average system, such as price closing back below the 5-day moving average, such as the 3-day exponential moving average crossing below the 8-day, is it keeps me in the trade. It keeps me unemotional. The market's just telling me to if it goes up, if it keeps going up, I don't know if it's going to do that, but if it does, then I'm going to stay in the trade and there's no emotion attached to that. So I'm looking to extract as much out of the trade, and therefore I can have a low win loss ratio, but sometimes I'm going to get 5 R's, sometimes I'm going to get 10 R, and that's going to keep me
Hmm.
in the game. That's what's going to keep me profitable. So again, coming back to your question, I'm looking at the movement in the market, and that's going to dictate my leverage ratio. And I don't want to change my leverage ratio on every trade. You're just never going to do that. You're never going to get on your platform and say, I want to switch from 500 to 1 to 100 to 1 to 50 to 1 if you're a pro client, and go. But you want to do it when the volatility regime changes. Secondly, that when there's big range expansion coming through in the market, that you want to trade with a wider stop, and your position sizing is going to come down. Conversely, if you see very low volatility in the market and low range, and average true range is the one that most people use in that. And then you can trade with a narrower stop and obviously increase your position sizing and your leverage accordingly. So that's I'm looking at that, and I'm looking at the volatility in the market, and my risk that I'm taking on the position is thematic of the volatility in the market. Obviously, your account size is obviously true as well. If you're trading with a small account, say less than $5,000, you need to be aware that your position size needs to be in fitting with that. You can't just go and do 10 lots of euro dollar, because the chance of blowing up your account is going to be very high. So they're the factors that I really look at. And then of course I'm looking at the calendar, and I'm probably looking at the calendar 2 weeks ahead, to understand the big marquee event risks. Because what you'll see is when the market catches on with a psychology of a thematic, like, okay, we're waiting for the next Fed meeting. What could the dollar do? What could rates do? What could things tend to trend into these meetings as well, and I just want to be aware of those event risks. So that's kind of how I'm managing risk.
Yeah, it's really fascinating listening to you talk about your momentum strategy, because it's kind of the opposite of what a lot of beginners are taught. Is that you've got to keep your strike rate about at least 60%, and then
Yeah.
listening to you talk about this momentum strategy and saying it doesn't really matter to you. But then I guess you're very experienced and you understand exactly what you're looking for.
It's exactly what happens, right? So if you get a bunch of new traders together in a group, they're all just sitting there talking about what's your strike rate, what's your max drawdown,
Yeah,
all those factors.
yeah.
But for me, the strike rate is thematic of the strategy. So if you get some experienced trend followers who run systematic trend following systems,
Mhm.
either algorithmic, that have been back tested, or ones that just sort of purely rules based. There's a theory that they're hunting for what they call outliers on a distribution. So that's more of a statistical anomaly. But really, what they're doing is they just don't care about the strike rate. Obviously, if they can get 100%, then happy days. But they know that's not going to be the case. The problem with a lot of breakout strategies, which are thematic with momentum, is that you get a lot of failed breakouts, and those failed breakouts can be very powerful as counter moves. But we want to cut those positions very quickly. So if we buy a breakout, maybe price closes above an upper Bollinger Band, maybe above a 40-day high, we use a Donaldson channel. That could mean something. That could go on to be something very powerful, or it might not. And if it's not, we want to cut out very quickly. But if it goes on and starts to trend, if it starts to show this strong underlying momentum, then you want to be part of that, and you want to extract as much out of that trade as possible. There are strategies where the win-loss ratio does matter a lot more. If you get some mean reversion, for example, I don't trade mean reversion as much. I'm not as active in mean reversion, but in those situations, you would be targeting your strike rate. So your risk reward may mean less, but I want to be getting a 65 to 70% strike rate on my mean reversion. So I think it really depends
Mhm.
on the actual strategy that you're running, whether you actually care about win-loss ratio, or whether your reward to risk is far more important. In some cases, actually, what you're trying to be rewarded for, the amount of risk you're taking, can actually be far more important.
Yeah, no, that's really fascinating, and because you mentioned at the start that that you think beginners should look at momentum trading as a strategy to start off with, and so would you recommend for beginners just to be aware that they don't need to be quite so fixated on their strike rate when they're if they're starting out with a momentum strategy?
Exactly. Yeah. So
Yeah,
your job is to cut your losses as quickly as you can, um, and that may even mean So you've got your stop loss in place, and your stop loss represents how much risk you're taking on. If you know your
yeah,
defined risk, without any kind of gapping, then you can say to yourself, well, I know the kind of areas that I want to target as reward. And
hmm,
in those kind of momentum strategy, what is momentum? Momentum is a vector. So it means there's two things going on. One, that is the rate of change needs to be going in one direction. Also, price needs to be going in the same direction as well. This is why the first thing you look at in momentum is rate of change. Typically you need some sort of breakout strategy as well. This is why a lot of people will use Bollinger Bands. So you'll see like a narrowing of the Bollinger Bands, which means that the price action is becoming more confined, and realized volatility is falling. And
hmm.
that can be quite a powerful force when you get an upside break, and it's combining with other oscillators as well. Price action is also really important. But people say, Chris, would you trade with a price target? And for me, no, because price targets can be good in this situation if you've got a defined risk. So you've got your stop loss in place, and you know how much risk you're taking on. So you can say, ideally I'd like to target this kind of level, and it gives me a 3R. But if you're letting the market do the work, you see some of these trends that have developed over the last couple of years. Go and have a look at dollar yen. I mean, last year was a fantastic one, and just pull up just a simple 3-day exponential moving average crossover versus the 8-day, and market has a little bit of a pullback. Retail traders are taking profits on that trade because they don't want to surrender those profits, because
Yeah.
you have to be proven right. This idea that you can never go broke taking a profit. Well, I would say that probably the worst saying in financial markets is you can never go broke taking a profit, because you can, and retail traders do go broke taking profits. The thing is, they let their losses run too much and they take their profits too quickly. So that saying to me is the worst saying in financial markets. And you just got to extract enough out of that trade. So just when you get these powerful moves, these impulsive moves up, we don't know when they're going to stop. We have no prophecy, no ability to forecast that. It can keep going, especially in cryptos, for example, where you can get some really powerful trends playing through. So I don't trade with price targets. I don't trade with limits. I just let the market go up until the price gets me out.
Yeah, it's really interesting to hear you say that. I mean, it's again a lot of beginner orthodoxy. Is to set a limit. Don't let the price run. This kind of discipline. And I guess what you're talking about for you personally as well is that requires a quite strong, not only an understanding of the markets, but then quite a strong psychological aspect to it as well.
Not really. If you're using a systematic approach or a mechanical approach, there's no emotion involved at all. If you're just using, I mean, just those. You could have an ATR trailing stop. You could have a moving average trailing stop. Just something very simple like that keeps you in the position. And
Right.
and that's just a rules based situation that says, I'm not going to get out the trade until this actually has completed or done this rule. And therefore, you're just removing all bias, you're removing all emotion from the market, and that can be very powerful indeed, because retail traders, society says that we have to be right in everything we do. In trading, that's just completely the opposite. We're wrong a lot, and it's how you deal with being wrong that makes you a good trader. For me, running some sort of mechanical system means that you remove all the emotion out of trading, which is the devil's work for a lot of people learning to trade.
Yeah, absolutely. That's good. I mean, just moving on from that. I mean, I saw over the weekend, and I mean, yeah, I know you do this all the time. You posted a weekly outlook on Twitter on Sunday night with a lot of good advice for what traders to look out for
Yeah,
the coming week.
thank you.
And the fate of the USD, that takes up a lot of your advice in there. But where do you see the USD going in the short to medium term?
Well, adopting my momentum hat.
Yeah,
For people who can pull up a daily chart of the dollar index or the DXY, 57% weighted towards euro dollar, of course. Um,
yeah,
there's a huge amount of resistance around 104.92, and until we can clear that level, I think we're just going to chop around with a small downside bias. So I've got my levels, I've got my alerts, and I want to see price close above that on a daily basis. That would definitely interest me for a potential move up to 106, maybe even further higher. It might even start trending, and that's what I'm looking for. But from a fundamental perspective, I've got my checklist of things that need to go right for the US dollar to bull trend. We need a US exceptional story to really kick off, and that means that global growth is falling, but the US is looking better. It's the best house on a shabby neighborhood. Are we there? We're not. We're nowhere near that point at the moment. I mean, we're seeing Europe natural gas prices at $43.
hmm
They're in decline. European inflation's high. European growth's looking better than what people were looking for. Emerging markets are in a better spot. Certainly, China's growing better. So global
yeah,
growth's on the up, and generally the US dollar does well in a falling global growth environment. So that sort of checklist isn't there at the moment. From an interest rate perspective, well, interest rates in Europe have been going up, or interest rate expectations in Europe have been going up far faster over the last couple of weeks than what we've been seeing in the US. So from that perspective, while we've seen interest rate expectations in the US going up, they've been going up faster. And you can see that in short-term bond yield differentials. So euro dollar's been going up as a result of that. So I can easily make a bull case for the US dollar, but yet we're not at that point where the checklist is marrying up. And if you have a look at the price action and the just what we're seeing in the daily chart, it mirrors that situation very, very clearly as well. So I want the market to tell me when to push me into a position. And if I'm using the dollar index as a proxy for the dollar, I know that it's a pretty poor representation, but it's just probably as good as we got as traders.
Yeah.
Um, I think I really want to wait for a break of 104.92, and I think if we can get a closing break of that, then my tactical bias will become significantly more bullish coming through. I think saying that at the moment, we've got a bit of a grind. Volatility is pretty low in FX markets, which means it sort of plays into my leverage ratios and how much risk I'm taking on a position. But I think if we get a move sort of through 103, which you can see a really nice consolidation through mid-February. I think we'll be talking to clients about a much more tactical sort of bearish bias coming through, and how that changes our sort of thinking around sort of dollar pairs as well.
Yeah, no, it's a really interesting time, and as you said, and I think in your statement, that everybody's kind of just looking at the data at the moment. It's just
We're all
wait
data
and see.
dependent. We're all data dependent.
Yeah.
The Fed are data dependent. They're kind of working on 2-week cycles. So they want to get their non-farm payrolls numbers. They want to get the US CPI numbers, and you've got this sort of tier 2 data piece that releases coming through, and then they're making the assumptions of like if inflation's not going down as much as they want, maybe we need to go up to 50 basis points. Maybe we need to show that we need to raise the increments up to get the Fed funds rate to another plateau higher than where we are at the moment, which I think if we get to that point could have some big ramifications for global markets. And I think global markets at the moment, they've been pretty resilient in the face of rising interest rate expectations because global growth has been going up. So growth for me is the most important factor. Central banks have been raising rates. We've seen Fed funds going up 450 basis points this year. The ECB are talking about raising rates to 4%. We saw the RBA potentially go up to 4.1%. We can talk about this as cows come home, but the fact is that global growth's been very strong. And until we get to the point that global growth really starts to show that these rates are now manifesting in lower demand and possibly higher labour markets or labour unemployment rates, it's that point when I think we're going to see bigger volatility coming through, because that's the point when markets say, well, hang on, this recession that everyone thought we were going to have at the beginning of the year is now
keep
manifesting.
on talking about.
Well,
Exactly.
the recession's been pushed back, right? So, but there will be a point where those interest rates will get to a point where they will start impacting markets. But it's when the realized data comes in and shows vulnerabilities. That's the point when I think we're going to see higher realized volatility and implied volatility in markets. And that's the point where I'll be saying to clients, leverage ratios should be taken down because we're getting much more pronounced intraday moves playing through in currency markets and indices. And that's where you could get more pronounced drawdown. And that's that point when the dollar could start trending as well. So growth, everyone's talking about interest rates. We're all completely obsessed with how high interest rates could go. Where's the terminal peak pricing coming through? But it's the point where growth starts to really falter. There's that equilibrium that sort of takes up from higher interest rates into falling growth. It's that point, which will come, I think, that you're going to see markets come alive. And I don't think we're going to see it just yet, but I think we will see it this year. And that's going to create really interesting trading conditions for traders.
I was going to say something to look forward to, but maybe not to look forward to, but to be aware of that this is coming down the track.
Everyone loves volatility until it actually hits. We saw people were craving volatility. 2020 happened, and it was the wrong kind of volatility. It was too crazy. The volatility. I mean, obviously we can take about the humanitarian aspect out of that, but from a markets perspective, the volatility we saw across markets in 2020 and March was insane. What was going on in crypto, in means and equity markets and fixed income. I mean, we were seeing 10-year yields bouncing around in 35 basis point moves. I mean, volatility works well until it's too crazy, and then everyone regrets it because they don't adjust to those scenarios. They don't take their leverage ratios down. They don't trade wider stops. They don't take their position sizing down. So everyone craves volatility. But when it comes, they can't adapt, and you have to adapt. That's what we do as traders. We adapt. We react to price moves. We adapt our trading systems to the volatility in the market. So I personally hope that we get higher volatility. I mean, obviously, it's probably going to come at the expense of higher unemployment rates. But my understanding is that you've got to understand that you've got to recognise the signs, and you've got to be able to adapt your trading and your accounts to those conditions as well. If you can do that, and if you can adapt your risk management, have a bigger margin, you will stay in the game. You will survive, and you'll potentially thrive as well.
Yeah, that's something else I wanted to talk to you about. Actually, is you mentioned there crypto, and the madness of crypto, and it's a pretty hot topic, and a lot of we get a lot of questions about it from visitors to our site, listeners to the podcast. How do I trade crypto safely? A lot of beginners, they're really interested, they want to get involved. It's a big buzzword, but they're also aware that it's that there's a lot of risk with trading crypto. And how would you go about trading such a volatile asset?
Yeah, I mean, I see crypto as a high beta risk asset effectively. So if the
Hmm.
Nasdaq's going up 1 or 2%, crypto in a risk on environment should be going up at a slightly faster pace. That's probably broken down a little bit now, but I think if we were to get a kind of correlations all picking up and risk on risk off vibe playing through, I think crypto will probably show its hand and revert back to that again. And that's where crypto can be an amazing trading vehicle. Yeah, look, people say the spreads are slightly wider, but you pay for the movement. There's nowhere that you're going to get 3,000 pips in
No.
an asset and pay 20, 30 points to do that. So yeah, again, look at the volatility in that market. You can't compare Bitcoin's volatility to euro dollar's volatility, for example. So you've got to look at the volatility in the market relative to itself. And this is where we look at things called percentile rank. So what is the volatility in the market relative to where it's been over the last 12 months in that individual asset? So we'd look at things like standard deviation. You can look at average true range, and I think that's a really good one for a lot of retail traders to look at. And you can look at
Hmm.
realized volatility as well, which again is measured in standard deviation. But you've got to look at its volatility relative to where it's been in the last 12 months. And you could be trading at 12 months highs. In that situation, I would be trading a wider stop. I'd be making sure my leverage is minimum. And I'd be obviously trading with a very low position sizing accordingly. Right now, the volatility is probably around the sort of 30th percentile of the 12-month range. So I'd be trading with a slightly narrower stop and maybe increasing my position size accordingly. But I think, crypto's been what we call a liquidity beneficiary. So it did really well when central banks were expanding their balance sheets. They were pumping reserves into the system. Commercial
Hmm.
banks were lending and all these factors. The opposite's obviously true now with quantitative tightening and balance sheet reduction and the dollar moving okay. But yeah, I think what I really like about this is when it goes, it can go. Yeah, it can be a brilliant momentum trading strategy. It can be a
Yes.
brilliant trend
Yeah.
following system. You get a lot of FOMO capital in there. When it starts going up, people are chasing it. You get a lot of optionality playing through. And so, from that perspective, I love crypto in that environment. Right now, it doesn't infuse me at all.
Hmm.
But from a trading perspective, when it goes and everyone's sort of standing on one side of the ship, they can be brilliant trending vehicles, brilliant liquidity, momentum vehicles. And yeah, look, the spreads are slightly wider, but you pay for the movement in the asset. It's like emerging market currencies. People say, why would I want to go and pay, 5 pips when I can buy euro dollar for, next to nothing? Well, you can get a 3% move in emerging market currencies. So you're paying for the movement, whereas
Yeah.
in euro dollar might only move 50 to 70 pips in a day, and that can really suit a lot of people's strategies, especially people who are trading EAs. They love trading euro dollar, but if you want that movement, you've got to pay up for it, and you're going to get that from Bitcoin, and you're going to get that from emerging market currencies.
Yeah, no, exactly. And I think that's true. And that's what we tell a lot of people is just, what's really been really great listening to you is talking about this risk management going into these volatile assets. And I think a lot of people, they don't understand that as long as you have appropriate risk management strategies in place and you've got your entries and exits sorted, the gains to be made are huge.
Yeah, that's right. And the thing is with risk management is it's not sexy. Do you know what I mean? It's like
It
everyone when
isn't.
they're
It
learning,
really isn't.
everyone's learning about give me an entry system. Tell me how to enter a market. Give me a breakout strategy. Give me a scalping strategy. Give me whatever it's going to be. They want to know how to enter the market, and that's obviously a really important part of trading. But that's all anyone
Hmm.
wants to learn. The ability to manage risk. That's what we do. We manage risk. We are risk managers. The ability to get correct position sizing relative to the volatility in the market. But the other thing that really, I just want to sort of say this is your ability to learn, your ability to know where your edge is, what we call continuous improvement. Your documentation of your trades, but then taking time to actually learn and actually review what you've done. That's the least sexy part of trading, but it's the most
Yeah.
important. For me, writing a journal is laborious, it's boring, no one likes to do it, but it's the way you're going to learn. Yeah, how else are you going to learn to become a good trader if you're not looking back and saying, well, you know what, I traded Asia, I was trading dollar yen, I was trading these currency pairs, and I traded like an absolute plum. But I
Hmm.
traded Europe really, really well. Now, what is it about Europe and that late European crossover into the US trading session that makes me such a good trader? I can see from my trading journal that I trade it really, really well, and I trade these markets really well in this system. Why is it that I'm trading well? Well, maybe it's because the news that's breaking is generally US centric and affecting these dollar pairs. And it's working really well for me. But I'm trading Asia really, really badly. You know what? This is where you say to yourself, well, maybe I just want to stop trading Asia as much and trade more of what's working. If something's working in your life, you do more of it. If something's not working
Yep.
in your life, you do less of it. Why can't trading be the same? Learn what works and do more of it. Learn what doesn't work and do less of it. I mean, it's exactly. I love running. I probably don't look like I love running, but I love it. I try and do it as much as I can. I try and do it as much as I can. And
Yep.
trading should be the same. But you can only find out what's working from documenting and reviewing your trade. It's the only way. And again, it just comes down to the thing: is this to be a good trader? Unfortunately, you have to take time to learn. And if you really want to do it, you'll put the hard work in, and you'll document those trades. You'll review those trades. Um, and you'll learn where your edge is. And once you understand the edge, you can harness and focus on that edge. And so for me, that documentation, what I call continuous improvement, is where you will become a really good trader.
I mean, and that's fantastic advice there, Chris. It really is, and it's something that we talk about a lot. And and it's like everything, not like everything else in life, but I mean, if you want to get good at something, you have to work at it.
Exactly.
Um,
Exactly.
yeah,
You've got to learn where your edge is. And that takes
yeah,
time. And going back to the demo account, I mean, for me, the demo account can be really important in terms of building a strategy and finding out where its edge is, and back testing it can be good if you can automate it or systematize it. But yeah, the step up from demo to live can be very, very problematic for a lot of people, because you're dealing with real money, real emotions, the ability to be right, taking those profits when the market starts turning, when you don't need to, being patient in the positions. So yeah, demos are really good. And they serve a purpose, but the step up into a real account for it, I think, can catch a lot of people out.
yeah. It does. And it's something we talk about a lot. The psychology of all of a sudden having your own money on the line can be
Exactly.
pretty scary business.
Yeah.
But Chris, I mean, thank you so much. I think we'll leave it there. I mean, you heard it here first. Work hard at trading, and you'll be a better trader. And thank you so much for joining us.
I just
I
want
think
to
we
say
lost.
this.
Yeah, go on.
I just want to say this, that I've been in the CFD game and the retail trading game for a while, and your job is to get past the first year. If you can get past the first year, your chance of making money goes up by, I just pluck a number out, but I think it's a decent percentage. If you can get into that 3 to 5 year duration, your chance of making money on a continuous basis moves up exponentially. So your first year as a trader is to stay in the game, is to survive. Okay, which doesn't sound particularly inspiring, but you'll learn a lot. You will learn a lot in that 1 year. And if you can stay into that 5 year, I've been at two different CFD shops now, Pepperstone obviously for
Mhm.
5, and you look at the statistics on people who are continuously winning trades and have an edge, and these are people who are typically in that sort of 3 to 5 year plus bracket. So you've got to survive. But when you get that and you can cultivate that edge, your chance of making money will increase, and it will increase. So don't give up, but you've got to survive the first year and hone your skills and become a better trader and put the work in. And yeah, statistics show you that after a period of time, your chance of making money in this game, obviously increases dramatically.
So educate yourself, work hard, and persevere. Basically,
100%, 100%.
yeah. No, and that's fantastic advice. I think a lot of beginners should take on board. Chris, we've lost Alison somewhere in here. I think her internet connection went down.
Well, I've just literally seen, as we've just been talking, that the South African GDP numbers have fallen by 1.3%, far worse than
Ah,
expected. So maybe she's gone off to
yeah.
trade it.
Entirely possible. I'll have to try and track it down and ask it. Chris, thank you so much for coming on today. you've been a fantastic guest, and we really hope to have you on again.
I'd
in the
love
future.
to. I really enjoy talking about markets with anyone. So yeah, really honoured to be part of your community. And if you've got any questions, do reach out to myself or the team at Pepperstone. We'd obviously be very happy to answer those. And I really hope to be back again.
Yeah, no, thanks so much. Have a great rest of your day.
Brilliant. Thanks very much.
Cheers.